Yes. Now we will learn the tax rates applicable on the capital gains income. Guys, we had already covered this in tax rates chapter under the tax rates on special income or special rates. I'm just repeating it again now. But now let us go a little deeper. Little deeper. Yes. Fine, sir. Let us get into it. Tax rates on capital gains income and whatever we discussed now, they all are special rates. Applicable on what? Special income. I had already explained it, guys. I had already mentioned it number of times. Capital gains income is special, except short-term capital gain on the transfer of any asset other than left. Other than left. If it is on left, it is a special income. If it is any other asset, it is not a special income. Correct? Huh? Okay, let me repeat it once again. It's okay. Long-term capital gain on the transfer of any asset, always special. Short-term capital gain on the transfer of left is special. Whereas any other asset, normal income, taxable at normal rate as applicable to the assessee. Let us learn it. Section 111A. Short-term capital gain on the transfer of left. What is that left? LE stands for listed equity shares. F stands for unit of equity oriented fund. And T stands for unit of business trust. What is the tax rate applicable, guys? 20%. Condition for availing the benefit of this concessional rate are, that is, the STT should be paid, guys. STT should be paid. What is the condition they are telling us? The transaction of sale of such equity share or unit should be entered into on or after 1st October 2004, because this is the date on which STT was introduced in India. Okay. And such transaction should be chargeable to STT. In simple, I can tell, when you sell this, you should have paid STT. You should have paid STT. And even you would have paid it at the time of purchase also. But the condition is they're telling, when you have sold, you should have paid it. Okay. Sir, what if by chance I have not paid STT? It should be paid because it will be automatically deducted. It is not like voluntary payment. But still, what if I have not paid? Then it is not covered under section 111E. It becomes a normal income, taxable at normal rate. Clear? If this condition is not satisfied, then it is not covered under section 111A. If it is not covered under section 111A, it is not a special income. It is a normal income taxable at normal rate. Oh. Short-term capital gain arising from the transaction undertaken in foreign currency on a recognized stock exchange located in International Financial Service Center, that is in short we call it as IFSC, would be taxable at a concessional rate of 20%, as the case may be, even though STT is not paid in respect of such transaction. What are they trying to tell here is, guys, they put a condition here of STT payment, right? Yes. But they are giving exemption in one case. When is it? If you are operating your unit in IFSC, that is International Financial Service Center, we also call it as Gift City, which is actually in Gujarat. Gift City. So that is an IFSC set up in India. If you are operating there and if you are earning your income from foreign currency or foreign exchange, then they are telling for you, STT is not applicable. STT is actually exempted for them. STT is exempted for them. Now I have a unit in IFSC. From there I purchased some shares and I sold it. STT was exempt for me. So I didn't pay STT. What is the tax rate applicable for me? 20%. Still, is it covered under section 111A? Yes, one of the exemption. One of the exemption given. Hope you understood. In any other case, if STT is not paid, then the short-term gain is not covered under section 111A. Okay. Next, note. All other short-term capital gains are taxable at normal rates applicable for the assessee. Such short-term capital gains are outside the purview of what? Section 111A. In simple, short-term capital gain on the transfer of asset other than left is always normal income, taxable at normal rate. Next, coming to long-term. Long-term capital gain, let me finish first 112. Long-term capital gain on the transfer of, again, LEFT, same assets, guys, same assets. But now the nature is what? Nature is what? Long-term. Okay. Long-term capital gain on the transfer of LEFT is taxable at what rate? 12.5%. but in excess of 1,25,000. Means up to 1,25,000 it will not be taxable. And 1,25,000 is the total in year. Sir, every time I sell, will I get 125, 125 every time? No, no. In a year, the total exemption is 1,25,000. For example, listen. I have a long-term capital gain on the transfer of listed equity shares, 2 lakh. What should I do with this 2 lakh? Include entire 2 lakh under the head capital gains while computing income. But while calculating tax from 2 lakh, reduce 1 lakh 25, and on the remaining 75, I need to apply how much? 12.5%. Same way, assume my long-term capital gain on the sale of listed equity shares is only 1 lakh. Include entire 1 lakh under the head capital gains. Include entire 1 lakh under the head capital gains. But while calculating tax, it will be 0 because it is within 1 lakh 25,000. Hope you guys understood. So this 1,25,000 is not the exemption given while calculating the income. It is an exemption given while calculating the tax. That means whatever is your long-term gain, include it fully under the head capital gains. But while calculating tax, what should you do? Reduce 1,25,000. On the remaining you will claim, you will calculate 12.5%. So please be careful because students might commit a mistake by reducing this 125 while computing income itself. Please don't do that. In that case, your total income will be understated, which is wrong. Okay. Here also condition is, if it is equity shares, STT should be paid both at the time of purchase as well as sale. And if it is a unit of equity oriented fund or unit of business trust, then STT should be paid at the time of sale. Sir, what if by chance if STT is not paid? Then long-term capital gain is not covered under section 112A. Then where it will be covered? 112. 112 guys. Because any long-term is special only. If not here, where is it covered? 112. 112. Okay, fine. But here they are telling the same story. What they told above. If you are a unit in IFSC, operating in IFSC, if you are a unit operating in IFSC, and if you are not paying STT because exemption is given for you, still the tax rate applicable for you is 12.5%. Clear? That means the gain is covered under section 112A itself. Okay. Fine. Next. There is no benefit of indexation and currency fluctuation under this section, guys. Even though we are computing long term, sir, can I claim indexation? No. Sir, can I claim the benefit of currency fluctuation? No. What is the currency fluctuation? Guys, I have bought and sold the shares of Indian company, listed shares in foreign currency. When I bought, exchange rate was different. When I sold, exchange rate is different. Can I take the advantage of exchange rate fluctuations? No. You cannot adjust it. You cannot adjust it. Oh, now this is important. This is important. Guys, when we are computing the long-term capital gain under section 112A, the cost computation is different. Normally, what is cost of acquisition? My cost of purchase. But here, they are giving something else. They are giving something else. What is it? We will see. Yeah, we will learn here. Guys, before I explain the cost calculation, I will explain the concept behind it because it is important to understand the provision. Listen here. If there was a long-term capital gain on the transfer of left before 1st February 2018, it was exempt fully under section 10 clause 38. Long-term capital gain on the transfer of left was completely exempt if it was before 1st February 2018. Exemption was given under which section? 10 clause 38. But later on 1st February 2018, Madam passed a new Finance Act telling we are withdrawing this section. We are withdrawing this section. That means if there is a long-term capital gain on the transfer of left from 1st February 2018, it is taxable. As per which section? 112A. 112A. Okay, fair enough. So if I purchase anything and sell after this, you are taxing me. Okay. But what about the people who would have bought the shares here with an intention to sell here. Correct, it can happen, no? Assume I had purchased the shares in 2015, thinking that in India, if I sell these shares over a long period, then I will enjoy full exemption. All of the sudden, in between, you come and tell it is taxable. Who is it fair? Correct now. So that is why they have added few condition telling. If you have made any gain till here, we will not tax. But if you have made any gain after this, we will tax it. We will tax it. Sir, how did they frame that provision? Beautifully they have done. Let us see it. I am trying to explain this with an example. Assume I have purchased the equity shares of a company on 1st August 2015 for rupees 1 lakh. And I am selling this on 20th September 2025, that is during our previous year, for 5 lakh. What is the actual total gain made? 4 lakh. Now, if they ask me to pay tax on 4 lakh, it is not fair on my part. It is not fair on my part. Why, sir? Because I purchased with an intention to claim exemption. All of the sudden, in between, you came and told it is not available. This is not fair. So, what Madam did was, whatever gain you have made from year to year, I will not tax it. For example, the new provision came from what day? 1st February 2018. We are taking preceding day. On the preceding day, what was the fair market value of that shares you checked? Assume in that my example, it is 2.5 lakh. I have not sold it. But if I had sold, how much I would have got it? 2.5 lakh. So what is the gain I have made from year to year? It is 1.5 lakh. We call this as unrealized gain. I have not sold it, but my portfolio on this date would have shown a profit of how much? 1.5 lakh. They are not taxing me this. They are not taxing me this. Okay. So after that, how much gain I have made? From 2.5 lakh till the time I sell, how much is the increase? 2.5 lakh. Is that taxable? Yes. How did they frame this, sir? Whatever I explained, they didn't tell so much in the law. What they told was, from sale value, you can claim fair market value on 31st January as your cost. As your cost. So automatically what happens? 5 lakh minus 2.5 lakh is how much? 2.5 lakh. So they are taxing me only 2.5 lakh. So indirectly, whatever gain was made from year to year, they exempted. They exempted it. Got it, huh? Hope you understood. Yeah. Yes. Sure. Let us read it now. The cost of acquisition for computing long-term capital gain under section 112A acquired by the assessee before 1st February 2018. Guys, this is applicable only for long-term asset which is purchased before 1st February 2018 shall be deemed to be the higher of the following. So, higher of A or B. What is it? A is actual cost. Fine. B is lower of two things. Lower of two things. What is it, sir? Fair market value of such asset as on 31st January 2018, that is immediately preceding day of this, okay, or actual sale value. Full value of consideration received or accruing as a result of transfer of the capital asset. In simple, actual sale value. Actual sale value. Sir, they are talking about fair market value, no? What is that? I have given a note here. The fair market value of the listed equity share shall mean its highest price quoted on the stock exchange on what date? 31st January. The highest price on 31st January. Clear? Because the price will keep on changing throughout the day during market hours. So what we will take it is the highest price of that shares on 31st January 2018, guys. Yes. Now let me try to convert this to my example. First, I will go with B. Lower of fair market value. How much was fair market value, guys? 2.5 lakh. Actual sale value is how much? 5 lakh. Whichever is lower, 2.5 lakh. Then actual cost is how much? 1 lakh. Whichever is higher is allowed. How much is that? 2.5 lakh. So how much cost can I claim? 2.5. Hope you understood. I repeat. Okay, let me go for this. First, I need to check B point. Lower of two things. Lower of actual sale value, 5 lakh. Or the fair market value on 31st January. Whichever is lower, 2.5 lakh. Compare 2.5 lakh with actual cost 1 lakh, whichever is higher. So which is higher? 2.5 lakh. So what is the cost of acquisition of this asset? 2.5 lakh. So how much gain they are taxing me? 2.5 lakh. When was it made? Only on or after 31st December, 31st January, or on or after 1st February actually. On or after 1st February, guys. Is that clear? Yes. Sir, what if by chance, if it was a loss and all? For example, this I have sold only for 3 lakh, or let me take it as only 2 lakh. I have sold only for 2 lakh. After this, I made a loss. Chances are there, correct? Now, share price can go anywhere. Assume this was 2 lakh. 2.5 or 2 lakh, whichever is lower, 2 lakh. Then 2 lakh or 1 lakh, whichever is higher, 2 lakh. Claim 2 lakh. Claim 2 lakh. Sale value 2 lakh, cost 2 lakh, gain 0. Gain 0. Hope you understood. Yes. Sure. You can make a note of it, but let me finish it fully. Then, sir, is benefit of indexation available for it? No. I had already told you, even though it is a long term, no indexation, irrespective of the date. Whenever you have sold it, no indexation, guys. Next, notes. Cost of acquisition for computing long-term capital gain in respect of above assets, that is left, LEFT, acquired on or after 1st February 2018 is the actual cost of acquisition without indexation. Sir, what if by chance if asset itself is purchased here, then will I get that benefit of higher or lower and all? No. For example, assume I had purchased the asset in 2020. What is the cost of acquisition? Actual cost. That's all. What is the cost of acquisition? Actual cost. When will all this comparison higher or lower will come? Is only if the LEFT is purchased before 31st January or before 1st February. Clear? Yes, sir. Hope you understood. Because if I purchase the shares newly on or after 1st February, I already know it is taxable. I knew, and even after that I bought it. Pay tax on whatever is your gain. No higher, no lower, only actual cost. That's all. Fair enough. Correct. Because Madam brought a new provision, section 112A, when it was introduced on 1st February 2018. Now, if I purchase the LEFT or equity shares on or after 1st February 2018, am I aware that it is taxable for me? Yes. Pay tax. Sale value minus cost is your gain. Pay tax on. For the asset which was purchased before 1st February, why they brought it was, before 1st February, if you have purchased, you were with a notion that I will enjoy exemption. But later, all of the sudden, Madam introduced a new section telling 112A, it is taxable. So it was unfair for the people who would have purchased before 1st February 2018. And actually, it was criticized by many investors. Government was criticized because of this move. So that is why they told, no, we will give this as a cost for you, claim it. Even after that, it was criticized. Why? Because, guys, actually they keep on increasing the rate also. Previously, it was 10%. Last year, Madam made it as 12.5%. Even I didn't like that move. Why? Because, sir, when we earn active income, I work very hard, you tax me. Later, using that money, I build something, which is passive income. You tax that also. And for that also, you are increasing the rate. So how is it fair for the people who are really working hard, earning the income and making money out of it? Tax on tax, tax on again and again you are leaving tax. Simple. I earned salary income or I earned professional income. I paid tax on it. Clear? Then out of that, a part I saved, I invested. I earned income out of it. You are taxing me that also. If it was at a lower rate, when she introduced, it was 10%. Now they have made 12.5%. Any day in the future, it may become 15%. Because 12.5 is odd figure. No, let me make it 15. Clear? Or 15 is less 20. If they keep on increasing, then what's the use? Clear? Of doing all this. Sir, Aram say, we will depend on government, you take care of us. Okay, every month you give me, you take care of my needs. Why to work hard? Correct. That is what actually is happening. They are trying to squeeze the people who are working hard by charging more and more tax. But one good news recently is GST. To some extent, on some items, GST has been reduced, but on our service, it is 18% only. No good news for us. But when it comes to household items, necessities, and all, or daily used items, they have tried to reduce the GST rate, which is actually a good move by the government. Okay, sure, we'll proceed further. Whatever they do, we have to accept it because we don't have the power to change the government. We have only power to vote. Okay, and whomever we vote, obviously we would have voted with some good intention only. But what they take decision, we don't have any control over it. We don't have any control over it. Whatever they do, 1 or 2 days we may criticize it. Third day we will accept and move on. Yeah, second note. No benefit of rebate under section 87A against long-term capital gain taxable under section 112A. Guys, we discussed rebate under tax rate chapter. It is available to a resident individual whose total income is within certain limit. But for the resident individual following either default regime or optional regime, they cannot claim rebate against 112A tax. Against 112A tax. I will speak little more about rebate, but little later. Okay, we have covered 112A. Guys, we had kept few points pending under the cost. Come to that. Under the cost, we had kept this pending. Come to this. Page number 129. 129. Yeah. Guys, if it is the unlisted bonus shares issued on or after 1st April 2001, what is the cost of acquisition? Nil. It will be nil. Then, sir, what if it is the listed equity shares? It is a part of LEFT. It is a part of LEFT. LE stands for what? Equity shares. Oh, sir, I was holding the equity shares. They gave me free shares, bonus shares. What is the cost of acquisition for it? The IR of, as per 112 year. The IR of actual cost, which is actually nil, or lower of FMV as on 31st January 2018 or actual sale consideration. Clear? So here for sure it will be 0. Whatever you get here, no, whichever is lower, straight away take that only as cost of acquisition. Straight away take that only as cost of acquisition. This is for listed bonus shares. Sir, what if it is normal shares or any asset LEFT? LEFT, which is not a bonus. Then this part we already discussed, guys. I'm just repeating it again here. Long-term capital assets being listed equity shares in a company on which STT is paid both at the time of purchase and transfer, or unit of equity oriented fund or unit of business trust on which STT is paid at the time of transfer. In simple, LEFT. First point is LE, second point is FT. Okay. If it is acquired or purchased before 1st February 2018, then what is the cost of acquisition? Cost of acquisition will be higher of actual cost or lower of FMB as on 31st January or actual sale consideration. Got it? Same like however we discussed 112A. Same thing is repeated here. Clear? I had told I will cover this after 112A. I just covered it up. That's all. Come back. Come back. We have covered 112A. 112 we will do. Guys, 112. Any long-term gain other than LEFT is covered under 112. What is the tax rate? What is the tax rate? Lower of 20% with indexation or 12.5% without indexation. But please be careful. This is only when calculating tax. This is only while calculating tax. While calculating income, it should always be without indexation. Calculate the income and include it under the head capital gains. Okay, fine. Listen. Okay, first, which is the asset I will talk? Because there are two assets, a category covered here. First, let me speak about it. 112. Section 112 covers any asset other than LEFT, which is long-term in nature. But under that, there are two categories. Long-term capital gain on the transfer of other than covered under section 120A. That is other than left. If it is a land or building or both acquired by whom? Resident individual or HUF. When did they acquire? Before 23rd July. They have acquired it before 23rd July. But they have sold it after 23rd July. What is the tax rate, guys? You need to compute two capital gains. One is without indexation. The other one is without indexation. Whatever long-term capital gain you have computed with indexation, on that what is the tax rate? 20%. On whatever long-term capital gain you have calculated without indexation, what is the tax rate? 12.5%. Sir, should we pay both? No, whichever is lower. Whichever is lower. Okay, I will speak little more about it later. Okay, any other case, guys? Any other case? What is the tax rate? 12.5% without indexation. Land or building or both acquired by resident individual or HUF after 23rd July. If it is before 23rd July, indexation is there. But if it is after 23rd July, new provision was already introduced. You know that there is no indexation. That means even if it is a long-term asset, no indexation. Tax rate is 12.5% on the gain without indexation. Sir, should we calculate two figures here? No. Or any other assets acquired anytime. Any other assets means what, guys? Banu Prakash. Any other assets means what? Other than left and land and building. Other than left land and building, like gold or any other asset will come. Okay. Even unlisted shares and all. In case of non-residents, long-term capital gain on the transfer of unlisted securities or shares of a closely held company would be taxable at 12.5% without indexation and foreign currency fluctuation. In simple, this is what is applicable. Okay, now please remember this case. In any other case, what is the tax rate? 12.5% without indexation. Guys, you have to remember one major date, which was actually a part of last financial year, which is 23rd July 2024. Once the new government was elected, that is in central, they came back with a bang and they told, we are changing the capital gains. Madam made some major changes in capital gains. Head, guys. Lot of changes she made. Okay. Now, if the transfer was before 23rd July, things were different. If the transfer was on or after 23rd July, things were different. But for you guys, it is not like that. From 1st April to 31st March, it is same. But 23rd July, please remember, because it is one remarkable day for the government. If the transfer had happened before 23rd July 2024, for long-term assets, indexation was available. But if the transfer was made on or after 23rd July 2024, which includes our previous order also, no indexation on long-term assets. No indexation on long-term assets. But indexation is available only for land and buildings sold by resident individual or HUF, purchased before 23rd July, but sold after 23rd July 2024. But that indexation is for only tax purpose. Only for tax purpose, guys. Okay, sir. Fine. So we're done with this 112. I have a note for this. Come below. Yeah, this one. When I was explaining about the indexation also, I told I would be covering it little later. We are doing it now. Yeah, guys, while talking over the points on computation, I had explained you how to calculate indexation and all, because it is good to know. If indexation is applicable, how to apply it. But now we are learning exactly when is it available, sir. Exactly when is it available, sir. Yeah, when are we applying these provisions is only for two assets sold by only two assessees. Only by two assessees. When is it? We will see. Indexation benefit for long-term capital assets. Consequent to the amendment made by Finance Number 2 Act 2024, guys, in the year 2024, which was a central election year, there was two budgets. One was before the election, the other one was after the election. Normally, every year there will be only one budget, only one finance bill. But only in the election year, there will be two. Oh. In section 48, no indexation benefit is allowable on long-term capital gains arising on transfer of any capital assets taking place on or after 23rd July. Means for any long-term capital asset transferred on or after 23rd July 2024. Guys, this date is falling in our previous year or last financial year? Last financial year. Except, means for the following, indexation is available. Except land and building transferred by whom? Resident individual or HUF, on which indexation is optional at the benefit of assessee. It is optional for him. If you want, he can take it. If not, ignore it. Now, what should they do then? A resident individual or HUF, while computing tax on long-term capital gain, while computing what, people? While computing income or tax on? Tax. While computing tax on long-term capital gain on the transfer of land or building or both, as the option to take the benefit of indexation under section 112 in respect of long-term capital gains arising on transfer of land or building or both, which is acquired before 23rd July 2024 and transferred when? On or after 23rd July 2024. Guys, all conditions has to be satisfied. Let us see the conditions one by one. Who is the assessee? Resident, individual or HUF? What are they selling? Land or building? When did they buy it? Before 23rd July 2024. When are they selling it? On or after 23rd July 2024. Only then indexation is available. But when? But when indexation is available? While calculating tax, but not while computing total income. Accordingly, long-term capital gain on the transfer of such land or building or both are subject to lower of tax, that is at 12.5% on the gain without indexation or 20% on the gain with indexation, whichever is lower. Okay, I have given the steps here. Sir, actually, if by chance if the question is on this asset, what should we do, sir? Guys, we have a questions, we'll be solving it. But before that, let us understand the application. Okay, yes. I have tried to cover the questions on all the applicable provisions. We will solve those questions, but let us understand the provision first. Okay, first what should we do? First, include the entire long-term capital gain without indexation on transfer of land or building or both, where in the total income calculation, under which head? Capital gains. Then, while calculating tax, what should I do? I should have two figures. Long-term capital gain without indexation, long-term capital gain with indexation. Oh. While computing tax liability of the resident individual or HUF, calculate tax on long-term capital gain without indexation at 12.5%. This is on the gain without indexation. Compare that with calculate tax on long-term capital gain with indexation at 20%. Take whichever is lower. How much tax should the assessee pay? Whichever is lower. Other calculations remain same. Other calculations remains same. Okay, I will try to explain this with an example, guys. I had actually discussed the same example when I was doing tax rates. I will just do it again. Yeah. We are computing what is the amount of tax under section 112. Please observe the figures and dates. I had purchased, assume the asset is land or building or both. Purchased or sold by whom? Resident, individual. Let me mention that also. Asset is the land or building. Sold by whom? Resident, individual. Okay, sir. Date of purchase is 10th October 2015. That is 2015. Cost of purchase 10 lakh. Date of transfer is 10th November 2025. That is our previous year. Should we compute the gain? Yes, sir. Of course. Sale value is 50 lakh. Sale value is 50 lakh. This is the information given in the question box. Okay. Now we should first calculate long-term capital gain without indexation. How much is that? 50 lakh minus 10 lakh. No indexation. Just cost you reduce. How much we are getting? 40 lakh. What should we do with this 40 lakh? Include it under the head capital gains while computing total income. Okay, sir. Now we are computing tax liability on total income. How should we calculate? On this special item we are discussing. Calculate tax on long-term capital gain without indexation. What is that gain? 40 lakh. On that, what is the tax rate? 12.5%. The figure comes to 5 lakh. The figure comes to 5 lakh. Then compute long-term capital gain with indexation. With indexation. How is it, sir? Reduce the, from sale value, reduce what? Index cost of acquisition. What is the index cost of acquisition? Take the cost of acquisition into Cost inflation index for the year of sale. Which is the year of sale? 25, 26. What is the cost inflation index for this? 376. Divided by cost inflation index for the year of purchase. That is for 2015-16. I have only given 254. If question is there, they will give it. Don't worry. 254. So what would be the index cost of acquisition? This figure, guys. So if I reduce it from 50 lakh, what are we getting? 35 lakh 19,685. What do we call it as? Long-term gain with indexation. With indexation. On this, what is the tax rate applicable? 20%. Calculated. It is coming to 7,03,937. Sir, what should assessee pay? Whichever is lower, guys. I have given the name A or B, whichever is lower. How much? 5 lakh. 5 lakh. That means actually this was not there when Madam removed the indexation, especially the real estate sector and common people who would have purchased the land, building, and all. There, lot of people, industry experts also criticized it, telling for land building, how can you remove the indexation? Because that is the asset which would have appreciated over a period of time. How can you remove indexation? What, correct, no, guys? Because assume I would have purchased an asset for 1 lakh. Today it is worth 1 crore. Okay, you are asking me to pay tax on 99 lakh. I have kept that asset for 20 years, 30 years, 40 years. Now all of the sudden you come remove the indexation and tell pay tax on 99 lakh. It is not fair. Correct now. So madam brought back the indexation, but only on this. Only on this. What is that? Land or building sold by resident individual or HF. When? On or after 23rd July. But purchased when? Before 23rd July. Now listen. Sir, in 2025 I purchased land or building. I am selling it in 2050. Is indexation available? No. Why? Because on 23rd July we already removed indexation. You are aware. You purchased land or building after that. I am not giving indexation. I am talking on behalf of whom? Madam. Okay. Chalo, don't scold me. There also they have played one trick, you see. How beautifully they have trapped the people. Many common people will not understand this. I will explain. Don't tell anyone. Listen. Now, they told indexation is available only while calculating tax. Why is that condition? Simple. While calculating income, what is the income you will include under the head capital gains? 40 lakh. So accordingly, your total income will increase and you might be pushed to pay surcharge. You might be pushed to pay surcharge. Correct? Huh? Assume I have another income of another 10, 15 lakh. Assume 15 lakh. So what is my total income? 55 lakh. Should I pay surcharge? Yes. Means they gave indexation but only to calculate tax, not to calculate income. Why? Because they tried to push you. If by chance if you have higher gain, then I can collect surcharge also from you. You understood the trick. Correct. Assume here 40 lakh is the gain. No, obviously assessee might not have only gain. Assume he has some other income of 15 lakh. What is the total income? 55 lakh. Should he pay surcharge? Yes, 10%. Now listen. Now if they had asked me to include this, maybe I would have not paid surcharge. But you asked me to include this, I may end up paying surcharge. So some people might be stuck in between this. Clear? This is a pure trick played by the government. Okay, anyway. Government is government. Did we cover all this? Fine. Shh. Listen. You are telling bye for me? Chalo. Shh. Listen. As per my example, we should include entire 40 lakh in what? Income calculation. While calculating tax, we need to see both with indexation, without indexation, compute tax on it, take whichever is lower. Hope you guys understood. Clear illustration I have given so that you will get proper clarity with numbers. Guys. I have already made you guys to take down this illustration. I had already made you guys to take down in tax rate chapter. If you want, you can give connection. Okay, especially where this provision is there now, you can give connection for it. Refer, notebook, in page number, so and so. Yeah, now you can take down this chart. This is just for better understanding of section 112A. Year 1038 was removed. Take down this. Yeah, we shall continue. The tax rates on special income we have discussed. There are few common points, guys. Under all these three sections, there are some common points. What are those? We will see now. Yeah. First point A, I will do it little later. That is once I finish the other parts. B, assessee is not entitled to claim any deductions under Chapter 6A, that is from Section 80C to 80U, in respect of capital gains taxable under Section 111A, 112, and 112A, guys. Means against capital gains special income, assessee cannot claim Chapter 6A deductions. Assessee cannot claim Chapter 6A deductions. I will speak about this again when I go to deduction chapter. But as of now, you just remember, on capital gain special income, we cannot claim Chapter 6A deduction. All the deductions from 80C to 80U. Okay. Guys, one more thing. See, while computing the income under the head capital gains, the default regime or optional regime will not have any impact. Will not have any impact. Sir, can we claim everything under optional regime as well as default regime? Yes. Expenses on transfer, cost of acquisition, cost of improvement. Yes, allowed. Then later we will also discuss about exemption. Are those also allowed? Yes, they are also allowed, guys. Okay, C point. We had covered this in tax rate chapter C and D. I am repeating it here. Maximum surcharge applicable on capital gains taxable under section 111A, 112 and 112A as well as dividend income. What is the maximum surcharge rate applicable? 15%. But for an individual HU of AOP, BOI and artificial juridical person, if by chance if they are liable to pay surcharge at 25% or 37%, that is on the tax calculated on other income. Whereas on whatever tax we calculate on capital gain special income or dividend income, what is the maximum surcharge? 15%. Hope you guys can remember all that. We have discussed number of illustrations on this. Number of illustration both under optional regime as well as default regime. Next, D is an amendment. You have to be careful. In case the assessee is paying the tax under default regime, rebate under section 87A is not available in respect of tax payable on any special income. Any special income. Any special income includes any special income. That is capital gains under section 111A, 112, 112A, casual income under section 115BB, BBJ. On any of this, rebate is not available. Whereas if assessee is paying the tax under optional tax regime, then rebate is not available only against one tax. What is it? 112A tax. Whatever tax we pay on the long-term capital gain on the transfer of LEFT, only on that rebate is not available, guys. On other incomes, whatever tax we calculate, is rebate available? Yes, provided my total income is within certain limits. That is within 5 lakh or within 7 lakh, depending upon the scheme. Then STT paid. Guys, STT should be paid for a LEFT to be covered under 111A or 112A. Condition is STT should be paid. But can we claim STT as an expenses? No. STT cannot be claimed as expenses. Then D is, I have given about equity oriented fund, guys. So LEFT, one of the item covered there was what? Unit of equity oriented fund. You just mentioned there, the heading is missing. Equity oriented fund. Equity oriented fund. Equity oriented fund. Sir, what is it? A fund set up under a scheme of mutual fund or under a scheme of insurance company comprising unit linked insurance policy. That is, it also includes ULIP, which are not exempt under section 1010D. Guys, ULIP, when is it not exempt under section 1010D? Even in 1 year, if you have paid a premium of more than 2 lakh 50. We had discussed that in the capital asset definition. Okay, sir. Now, when do we call a fund as equity oriented fund? In case where the fund invested in the units of another fund which is traded on a recognized stock exchange, means we are investing in a fund, that fund is investing the money in another fund. Got it? Yes. In that case, a minimum of 90% of total proceeds of such fund is invested in the units of such other fund, and such other fund also invests a minimum of 90% of its total proceeds in equity shares of the domestic company listed on recognized stock exchange. Sir, what is it? Guys, assume Vikas invested in a fund 1 lakh rupees. 1 lakh rupees. So that fund minimum 9 lakh they have to invest in the other fund. That other fund has to invest minimum 9 lakh again with whom? With equity shares. With equity shares of which company? That too? Domestic company listed on recognized stock exchange. Clear? Sir, what if by chance 8 lakh is invested in recognized stock exchange, that is in equity shares, or only year 8 lakh? Then it is not a equity oriented fund. It is not a equity oriented fund. Hope you understood. I invested 1 lakh in the, sorry, 9 lakh Allah. This is, okay, let me make this only 10 lakh. Okay, I invested 10 lakh in the fund. That fund is not investing directly in the equity shares. That fund is investing in another fund. Minimum 90% they have to invest in another fund. And that fund should use the money to invest minimum 90% where? In the equity shares. That too, listed equity shares. Okay, let me make it more clear. Listed equity shares. Where listed? In the recognized stock exchange. And this shares is of which company? Domestic companies. Hope you understood. I am investing in fund. Fund is investing in another fund. Minimum how much they have to invest in another fund? 90%. And that fund should invest how much in equity shares? Listed equity shares of a domestic company? Minimum 90%. Clear? And please be careful. I am the person who is the investor here. Like this, number of people would have invested here and here. All that put together, minimum 90% they should have invested where? In the listed equity shares. Okay, sir. Next. Sir, what if the money is directly invested in the shares itself? Then I will erase this. What if the money is directly invested in the shares from the fund? It is not going through another fund, directly from the fund to equity shares. A minimum of 65% of the total proceeds of such fund is invested in the equity shares of a domestic company listed on a recognized stock exchange. For example, Vikas invested 10 lakh in a fund, mutual fund. Okay. Okay, let me mention that also. Okay, mutual fund. Okay, sir. He invested 10 lakh and this company straight away they are investing in equity shares, not in another fund, straight away in equity shares. How much they are investing in listed equity shares, sir? 90% of it, minimum 9 lakh. Minimum, sorry, not 90 lakhs, 65%, 6.5 lakh. Minimum 6.5 lakh. That is, I can tell, less than or equal to 6.5 lakh. Got it? Huh? Yes. Only then we call this as the equity oriented fund. Yeah. Yes. So fund to fund 90%. Whereas Vikas to fund to straight away equity shares, it is 65%, guys. Okay. And please be careful in the first example. I will just repeat it again. Hope you guys have done with this. See, listen. Vikas invested in the fund. How much, sir? Assume 10 lakh. Now this fund has to invest in another fund. How much? Minimum 9%. Sorry, 90%. How much is that? Less than or equal to 90 lakh. Now this fund totally would have received money from different people, right? Including Vikas, he would have got money from different people. Assume totally they have got 100 lakh. Totally they have got 100 lakh. So that means minimum out of this, how much they have to invest? Less than or equal to 90 lakh. Where, sir? In the listed equity shares. Listed equity shares of a domestic company in the recognized stock exchange. Because like me, there might be hundreds of people, thousands of people who would have invested year and year. So here they have to invest minimum 90% year. Same way here, whatever they have received totally, 90% they have to invest in listed equity shares of domestic company. Any doubt, madam? Any doubt? Huh? Huh? No, more than or equal to? Huh? No, minimum 90% means more than or equal to 90%. If it is, huh? Sorry? Lesser idre. Oh, is it? Okay. If it is equal to or more than 90%, then it is called equity oriented fund. Sir, what if it is less than 90%? It is not a equity oriented fund, guys. Oh, sure. So this is what equity oriented fund, guys. Let me come back to first point. This is crucial, especially while solving the problems. This is important. Yeah, please pay attention. For a resident individual and HUF, they are giving the benefit of adjusting the unexhausted basic exemption limit or shortfall against capital gains special income. Sir, what is it? Please understand, guys. I will give number of examples later. First, understand. This is available only for resident individual and HUF. Okay, first point. In case of resident individual and HUF, where the total income minus short-term or long-term capital gains, either under section 111A or 112 or 112A, is less than basic exemption limit, then the short-term or long-term capital gain shall be reduced by the amount not exhausted by any other income, and only the balance short-term or long-term capital gain shall be chargeable to tax at special rates. Guys, will my total income includes capital gain special income also? Yes. Now from total income, you remove capital gain special income, which is taxable at special rate. Remaining is what? Normal income. Check whether it is more than basic exemption limit. If yes, calculate the tax as usual. Sir, what if my normal income is less than basic exemption limit? Then whatever is the difference is there, no? I can adjust it against capital gains special income tax. I can adjust it against capital gains special income. Sir, how is it? One example I have given here itself. If other income of the associate, other income is normal income, 2,30,000, and long-term capital gain is 50,000. So what is the total income? 2,80,000. And assume associate is following optional scheme. So what is the total income under the optional scheme? 280. Okay. So what is the normal income, guys? 230. So total means normal income is taxable at what rate? Slab rates. Slab rate. What is the basic exemption limit under optional scheme? 2,50,000. Assuming the associate's age is less than 60. Okay. Now, my normal income is 2,30,000, which is taxable at slab rates. Whereas the basic exemption limit is 2,50,000. So what is the shortfall here? 20,000. Correct now? We call it as unexhausted basic exemption limit. That is basic exemption limit minus normal income. How much are we getting? 20,000. This 20,000, I can adjust it against my capital gains special income. How much is my capital gains special income? 50,000. Minus 20 will come to 30. So only on this 30, I need to pay tax. I need to pay tax. At what rate, sir? Depending upon 20% or 12.5%. Normally it will be 12.5 only. Clear? Only if it is a land building and all, we need to check it. Clear? Yes. Hope you understood. Guys, whenever my total income includes special income, what do we do? In tax rate chapter, we have learned. First, we will calculate tax on special income, then tax on normal income. On normal income, what is the tax rates applicable? Slab rates for individual and HUF. But if normal income is less than basic exemption limit, then whatever is the shortfall, we can adjust it against capital gains special income. But please be careful. This is available only for whom? People resident individual and HUF. Sir, what if it is non-resident individual or HUF? Assume in this question, the assessee was non-resident, then he has to pay tax on entire 50. Entire 50. No adjusting shortfall. Sir, what if assessee was any other person like AOP, BOI and all? They have to pay tax at 12.5% on 50 lakh. Is that clear? Nice. And one more thing, guys. See, under section 112, we have a tax rates. No, this is on the entire income. Here we will not reduce any 1,25,000. It is only for 112A what we reduce 125. Please be careful. For 112 long-term capital gain, on the full gain, it is 12.5%. Or if 20% is applicable, 20%. Got it? Same way 111A also. 20% is on entire gain. Nothing to reduce. Fine. Okay. So I have given in the note. Only a resident individual or HUF can adjust the basic exemption limit, that is 2,50,000 or 4 lakh against long-term capital gain under section 112, 112A or 111A. Guys, please be careful. For whom is it available? Only resident individual or HUF. And it is available against what all special incomes? Capital gains special income. Sir, can I do these adjustments against casual income? No, you cannot do. Please be careful. This adjustment is only against the capital gains special income, not on any other special income. Sir, what if this was 50,000 casual income? 50,000 taxable at 30%. That's all. Game over. Sir, I am a resident individual. Doesn't matter. Doesn't matter. So adjusting of shortfall is only for resident individual or HUF against capital gains special income. Okay. Thus, a non-resident individual and HUF cannot adjust their basic exemption limit against such capital gains. But such adjustment is possible only after making adjustment of what? Other income first. Other income first means first you adjust your normal income against basic exemption limit. If there is a shortfall, then you adjust that shortfall against your capital gains special income. Sir, what if the same assessee has both 111A special income as well as 112 and 112A? 112 and 112A is like almost same rates, 12.5%. So if you have the option, then always adjust first against highest rate. Tax planning. They have not put any condition. Assume there is a shortfall and assessee has all three capital gains special income. Against which one will you adjust first? Against which one will you adjust first? 111A gain. Why? The rate is more here. Take the benefit. Take the benefit. If you ask me next, what is it? Maybe 112. Why, sir? Because 112A has the benefit of 1,25,000. So next option is, okay, let me put it here. If assessee has all three, guys, 111A short-term gain, 112, 112 and 112A. In what order should we adjust the shortfall? First priority, give it for this, for sure. No doubt in that. Second priority can be for 112 or 112A because the rate is same. But if you want to encash 112A 1,25,000 benefit also, better go with this first. If still something is remaining, then last option is 112A. But this is not like mandatory. Can I interchange also? Yes. But go with this always first. If at all, if assessee has it. If at all, if the assessee has it, guys. Because here the tax rate is 20%. So try to adjust first against that. First against that. Okay. In other words, first other income taxable at normal rate are to be adjusted against the exemption limit. That is basic exemption limit. And then the remaining limit, if any, can be adjusted against long-term capital gain under section 112 or 112A or short-term capital gain under section 111A, guys. Got it? Yes. Guys, this will be an hidden adjustment in the question. When this is applicable, they will not give it in the question. Please check that. Please apply this, Anta. You need to know whether should I do this or not. We will also solve the question where this will come in between, which we need to take. Clear? So now we are almost done with all the provisions. We are ready to go for the problems. We are ready to go to the problems. But before that, I want to discuss few examples on whatever I just now discussed. Clear? Yes. Chalo. Please observe the figures, guys. I will try to give number of examples because there can be number of scenarios where the calculations keep changing. Calculations keeps changing. Yes. So what are those? One by one we will see. Please pay attention. In all the cases, assume assessee is a resident individual. Whatever examples I would be discussing, in all the cases, the assessee is a resident individual. Oh. Total income is 8 lakh under default regime. Is he eligible for rebate also? Yes. Please take care of that also. Okay. 8 lakh includes what? Long-term capital gain under section 112, 6 lakh. Normal income taxable at normal rate, 2 lakh. So, special income is taxable at special rate, but before that, check whether normal income is more than basic exemption limit. No, sir. Normal income is less than basic exemption limit. That means, first adjust there. Basic exemption limit under default regime is how much, guys? 4 lakh. So, how much is the shortfall? We call this as shortfall or unexhausted basic exemption limit. How much is that? 2 lakh. Can we adjust this 2 lakh against 6 lakh? Yes. So, I am adjusting 2 lakh shortfall here. Remaining is how much? 4 lakh. On 4 lakh, what is the tax rate applicable? 12.5%. I have taken everywhere under 12.5%. Okay. It depends on land building and all, but let us not worry too much about it. Oh. So on 4 lakh, what is the tax rate? 12.5%. So tax comes to how much? 50,000. 50,000. Sir, is rebate available? Total income is within 12 lakh. Rebate is available. But if I see the tax is on long-term capital gains, special income. Under default regime, rebate is not available against tax on any special income. So that means, can I claim a rebate? No. So what is the tax to be paid by the assessee? Plus 4% paid. That is cess. Health and education cess. Hope you guys are understanding. See the trick. Total income was within 12 lakh. That means rebate is available. But rebate cannot be claimed against tax on any special income. Is this the tax on special income? Yes. Under default scheme, you cannot claim rebate on it. Hope you remember that note. This note. This part. Hey. We'll move to the next one. Total income is 8 lakh under optional scheme. Under optional scheme is changing. Optional scheme. So is rebate available? No. Total income is more than 5 lakh. Total income is more than 5 lakh. So rebate is ruled out. Rebate is ruled out. Okay, sir. What 8 lakh includes? Long-term capital gain under section 112, 4 lakh. Short-term capital gain under section 111A, 2 lakh. And normal income, 2 lakh. First check. Whenever there is a normal income which is lower, first check. Is it more than basic exemption limit? No, sir. Under optional scheme, what is the basic exemption limit, guys? 2.5 lakh. So I am taking 2.5 lakh. Please be careful. I am changing the scenario. Sir, above you took 4 lakh, no, sir. Default regime. It was default scheme. That is why presence of mind is important. Or else what is happening? What is he explaining? You will not have an idea. In the exam, anything can come. So here it is optional scheme. So basic exemption limit is 2.5 lakh. So how much is the shortfall, people? 50,000. Let me put it in bracket. 50,000. Can I adjust it against capital gain special income? Yes, but we have to. Tell me against which is beneficial to adjust. Which is more beneficial? 111A. Why, sir? Because here the tax rate is 20%, whereas here the tax rate is 12.5%. So I will go with this. See, law permits you to adjust against this also, but you should be smart, no? Correct, no? Yes. You are smart, right? Adjust it against the highest rate first. So 50,000 you adjust here. Remaining 1.5 lakh will be taxable at what rate, people? 20%. And this will be taxable at what rate? 12.5%. Plus 4% pay the tax. Plus 4% pay. Hope you understood. No rebate here. Rebate is not available. Why? Darshan, why rebate is not available? Because the total income is more than 5 lakh. Is more than 5 lakh. Okay. Now listen, guys. Sir, what if by chance instead of this 2 lakh, it was only 20,000? What if this was only 20,000? Out of 50, I will adjust 20 here. Another 30 here. Remaining 30 here. Hope you guys got it. Yes. Let us move to the next one. Total income is 5,70,000 under default scheme. Rebate is alive. Rebate is alive, but let us see when can we claim it or not later. But is it alive? Yes, because total income is within 12 lakh. Okay. Total income includes normal income 190, long-term capital gain under section 112 how much? 380. 380. So what is the basic exemption limit under default scheme? 4 lakh. So how much is the shortfall? 2 lakh 10,000. Can I adjust it against capital gain special income? Yes. I am adjusting 2 lakh 10,000. So remaining is how much, guys? 1 lakh 70. On that, what is the tax rate? 12.5%, which comes to 21,250. Please stop at this point only. We call this as gross tax. Stop at that point. Check the applicability of rebate. Is rebate applicable? No. So total income is within 12 lakhs, sir. But under default regime, rebate is not available against tax on any special income. Against tax on any special income. So no rebate. So how much tax should the assessee pay? 21,250 plus 4%. 6. Got it? Yes. Make a note of it quickly. TI stands for total income, DS stands for default scheme, and OS stands for optional scheme. S bar F stands for shortfall. We also call this as unexhausted basic exemption limit, guys. Yeah, guys, I am just repeating the short form, means the full form of the short forms which I have used, because I don't want you guys to commit mistake while taking down. DS stands for default scheme, and here OS stands for optional scheme. BEL stands for basic exemption limit. SF stands for shortfall, or we call it as unexhausted basic exemption limit. Got it? Hey, did you got it? Good. Sure. Next one. We still have some more examples. Total income is 5,45,000 under default scheme. Is he eligible for assuming resident individual? I have told you all these examples is for whom? For whom? Resident individual. Okay, total income is 545. That means it is within 12 lakh. Can we tell is eligible for rebate? Yes. But let us see what is the tax amount. Okay, 545. If I split, normal income is 165. Long-term capital gain under section 112 gain is 3 lakh 80,000. Kumar Swami. Long-term capital gain under section 112 is 380. Okay. What is the basic exemption limit under default scheme? 4 lakh. Normal income is 165. So that means there is an unexhausted basic exemption limit of how much? 2 lakh 35. Can I adjust it against the long-term capital gain under section 112A? Yes. So against 380, if I adjust, what is the remaining amount? 145. Is it fully taxable? No. It is also not fully taxable. Why? I have a benefit of 125 under section 112A. Adjust that also while calculating tax. We adjusted. Remaining figure is how much? 20,000. On that, what is the tax rate? 12.5%. So our tax amount comes to 2,500. Can I claim rebate against it? No. As the assessee is following default scheme, no rebate against tax on any special income. Hence, the tax to be paid is plus 4%. This is the gross tax plus 4%. Okay, so next, total income is 5,70,000 under default scheme. In this, the normal income is 190, long-term capital gain under section 112A is 380. 380. Okay, sir. Now coming to basic exemption limit is 4 lakh, so there is a shortfall of 2 lakh 10,000. Can I adjust 2 lakh 10,000 against it? Yes. So 380 minus 210, remaining is how much? 170. Can I adjust another 125 which is given under 112A? Yes. Guys, please be careful. Hope you are understanding what is this. This is the benefit given under section 112A. Long-term capital gain on the transfer of LEFT is taxable at 12.5% on the gain in excess of 1,25,000. That 125 I am reducing here. Remaining is how much? 45,000. No rebate here also. So into 12.5%, you will get 5625 gross tax. No rebate because again it is tax on special income. So what should be the tax the assessee is paying to the government? Plus 4%. Plus 4%. Interesting. Total income is 4 lakh under optional regime. Yes, you are getting late? No, no? Okay, nice. Total income, at least, okay, leave. Total income 4 lakh under optional scheme. Unless again it will get late. Papa. So that is no stories. Only stick to the topic. Total income 4 lakh under optional scheme. Ramesh. Look here, Ramesh. Yes, that you will wait, Ramesh. In that normal income is 2 lakh. Long-term capital gain under section 112 is 2 lakh. So what is the basic essential limit under optional scheme, guys? 2.5 lakh. That means there is a shortfall of how much? 50,000. Can we adjust it against the special income? Yes, we are adjusting it. I am writing 0.5 lakh, which is nothing but 50,000. Remaining is how much? 1,50,000. On that, what is the tax applicable? 12.5%. So the amount comes to how much? 18,750. Assessee is following which scheme? Optional scheme. What is his total income? 4 lakh. Is it within 5 lakh? Yes. And assessee is a resident individual. Is he eligible for a rebate? Yes. Can he claim the rebate on tax under section 112? Yes. For the assessee who is following the optional scheme, rebate is not available only on tax calculated under long-term capital gain under section 112A. That means against the tax on the gain covered under section 112 or 111A, is rebate available? Yes, rebate is available. Even on whatever tax we calculate on casual income also, rebate is available. Provided total income is within 5 lakh. So what is the gross tax here, guys? 18,750. Is rebate available under section 87A? Yes. How much? Maximum 12,500. That is actual tax or 12,500, whichever is less. Actual tax here is 18,750 or 12,500, whichever is less. 12,500. So after reducing rebate, how much we are getting? 6,250 plus 4% cess paid. Got it? This is what the tax to be paid by the assessee. So I have tried to cover, guys, because any of this can come in the exam. We are not sure. So I have tried to cover all the different possibilities. It is always good to know because in the exam, when you see something for the first time, gone. Most of the students gone there only. Or else they would have done it, but they didn't know what they have done is. Right or wrong? Yeah, because all this, assume you see it for the first time. Will all this reflect your brain or mind? Maybe not. Okay, I'm not telling for everyone it will not, but majority of them, they may not get this part. But once we have covered this in the class, you know how to do it. If by chance similar things repeat in the exam, you will be able to take care of. Okay, sure. Fine. Take down. I have tried to combine the adjustment of unexhausted basic exemption limit along with rebate also. After this, we will solve good number of questions to understand the applicable application of provisions.